Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Energy Fuels Inc. quarterly report. Energy Fuels Inc. offers a diverse range of businesses and services, including uranium mineral property exploration, uranium recovery and recycling, vanadium pentoxide production and sale, rare earth elements extraction and sale, carbonate production and sale, heavy mineral sands mining, including plus ilmenite plus rutile plus zircon plus monazite. The stock price of Energy Fuels Inc. UUUU has skyrocketed by over 204% in the past year due to a combination of factors. The company's advancements in rare earth elements production have solidified its position as a critical player in the U.S. supply chain. Its White Mesa mill is now capable of producing separated rare earth oxides at a commercial scale, with successful production of high-purity neodymium praseodymium (NdPr) oxide and plans to target 99.9% pure dysprosium oxide by 2025. The uranium market has also experienced a resurgence, with global spot prices almost doubling in 2023 and continuing to rise in 2024. Energy Fuels has capitalized on this trend by restarting 3 of its uranium mines and planning to significantly increase production in 2025. The company's strategic positioning, financial strength, and alignment with U.S. critical minerals policy have also contributed to the market's positive outlook. The confluence of these factors, including favorable market and geopolitical trends, has driven Energy Fuels' stock price surge. As the demand for rare earth elements and uranium continues to grow, particularly in the electric vehicle and nuclear energy sectors, Energy Fuels is well positioned to capitalize on this trend and continue its growth trajectory. The primary drivers of revenue growth or decline in this company are largely influenced by its uranium sales, production levels, and market conditions. Revenue growth is primarily driven by increased demand for uranium due to decarbonization efforts, successful pilot-scale production of rare earth elements, and the introduction of heavy mineral sands segment revenue. Additionally, higher production of U3O8 from stockpiled and mined ore, as well as potential gains on marketable securities in uranium equities, contribute to growth. On the other hand, revenue decline is mainly attributed to the conclusion of mining at the Quail Project, processing activities ceasing, and lower mineral grades leading to losses. Lower uranium sales due to contract delivery timing and company decisions also contribute to decline. The company's operating costs have increased, particularly in exploration, development, and processing, which may impact future revenue growth. However, the introduction of new revenue streams, such as heavy mineral sands, is expected to offset some of these costs. Net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes over the past year. For the 3 months ending September 30, 2025, the net loss decreased by $4,676 compared to the same period in 2024, indicating some improvement. However, for the 9 months ending September 30, 2025, the net loss increased by $50,006, a stark contrast to the previous year. Profit margins have also been affected, with an operating income margin of -49% for the 3 months ended September 30, 2025. While expected to increase due to lower costs and conservative uranium price forecasts, it is anticipated that profit margins will drop in CONE 2026 due to spot sales of inventory. The fluctuating performance highlights the need for careful management and strategic planning to mitigate potential losses and optimize profitability. The company's financial performance indicates a concerning trend. Despite the efforts of its management team, the company continues to struggle with generating positive operating cash flow. As evident from the operating cash flow for 2025, which stands at -$73,269, and the overall assessment on page 74, the company is still in the red. This negative operating cash flow poses a significant challenge to the company's long-term sustainability and growth prospects. The company's debt level has increased significantly over the past year. The most notable change is the issuance of $700 million in convertible senior notes due 2031, which has added a substantial amount to the company's debt. This increase is net of issuance costs and represents a significant jump in the company's debt level. In terms of interest expenses, there have been some changes. The company now pays a cash interest coupon of 0.75% per annum, payable semi-annually starting May 1, 2026. Additionally, the notes bear interest at 0.75% per annum, also payable semi-annually starting May 1, 2026. However, it is expected that interest expenses will be greater than cash interest payments due to amortization of debt discount. Overall, while the company's debt level has increased significantly, its interest expenses have not changed dramatically. The introduction of the convertible senior notes has added a new layer of complexity to the company's financials, but the impact on interest expenses is relatively modest. Management is optimistic about the company's outlook, citing several key strategies that will drive growth in the coming years. In the short term, they expect decreasing costs of goods sold due to new low-cost ores and increasing gross margins from uranium sales. The company is also making significant progress on its rare earth elements (REEs) strategy, with plans to build heavy rare earth oxide production capacity at the White Mesa Mill in 2026. Additionally, they are accelerating rare earth initiatives, including Phase 2 expansion at the White Mesa Mill and development of the Donald Project in Australia. In terms of uranium production, management aims to increase output to up to 2.5 million pounds per year by 2026 with Whirlwind and Nichols Ranch mines, with a long-term target of up to 5 million pounds per year. They also see potential for significant growth in monazite procurement through acquisitions and third-party purchases. Looking ahead, management sees opportunities for the company to become the U.S. radium supplier of choice for TAT medical isotopes, with plans to continue advancing research and development activities on medical isotopes at the mill. Overall, these strategies position the company for long-term growth and success in the industry. Acquisitions and divestitures overview. The company has made significant acquisitions and divestitures over the past year. Key acquisitions include the purchase of Base Resources Limited on October 2, 2024, which acquired HMS Properties, as well as joint venture interests in the Donald Project and RadTran, LLC. The company also made opportunistic purchases of uranium during Q4 2025 and acquired rights to earn up to 49% interest in the Donald Project. In addition, the company has acquired several projects, including the Bahia Project and Toliara Project. Notably, the acquisition of Base Resources on October 2, 2024, marked a significant milestone for the company. On the divestiture side, the company ceased HMS production at the Quail Project in December 2024 and is currently in reclamation. The company also sold mining equipment no longer needed for completing reclamation activities, resulting in a gain of $1.81 million. Furthermore, the company issued non-qualified stock options to a consultant in exchange for investor and public relations services. Concerns about inventory buildup and supply chain disruption. The financial summary highlights concerns regarding inventory buildup and supply chain disruption. Notably, there is an increase in ore stockpiles from $15,491 as of December 31, 2024 to September 30, 2025. Additionally, finished uranium inventories have reached 485,000 pounds, with total inventories ranging between 1,985,000 and 2,585,000 pounds at the end of 2025. Furthermore, supply chain disruptions are also evident. The Toliara Project was suspended from November 2019 to November 28, 2024, indicating a significant disruption in supply. Moreover, potential concerns about transportation challenges, trade policies, production challenges, and restrictions on Russian uranium products in the U.S. may impact the company's operations. The expiration of the supply agreement with NEO in 2023 also poses a risk to the company's ability to sell RE carbonate produced by the mill. These issues collectively suggest that inventory buildup and supply chain disruption are pressing concerns for the company. That concludes the financial summary for Energy Fuels Inc. Feel free to comment below, and I will be happy to answer them when possible.